If you're shopping around for a fixed deposit, you might be attracted by the higher interest rates paid out on some foreign currencies. But does a higher rate mean you'll get more for your money? Higher rates often reflect higher risks, and one major risk for investors here is foreign currency exposure. In the past week, Trump's tariffs have sparked a dollar downturn.
Theoretically, with the high tariff, it also means that we are potentially expecting higher inflation, which means that the Federal Reserve is likely to keep interest rate higher, and that is going to keep the dollar strong, at least in the near term. However, in reality, in the last 2 months, the dollar has actually weakened. But this is on the back of trade uncertainties and also the irregularities which is being communicated from Trump's administration. So there's a lot of uncertainty in the market right now. This has eventually led to a weaker US dollar because the uncertainty and the fear that the market has today on the US dollar is starting to become more pronounced.
UOB says it expects up to 5 rate cuts over the next 2 years. It says that also means a weaker US dollar in the near future.
Now, the impact of this is actually quite profound on other currencies. For example, because of this uncertainty, other safe haven currencies like the Swiss and the Japanese yen is starting to look very attractive and very well supported in the near term. However, countries like export-driven or countries that are highly export reliant is likely to see a weakening demand because global trade is slowing and exports are starting to show weaknesses. So export currencies are likely to start weakening as well. And this is the same for commodity currencies. Currencies found in the Candy space, Canadian dollar, and also in the Aussie space is likely to see weaknesses in the near term as global trade starts to show weakness and start to slow down.
Here's how currency movements could affect your foreign currency fixed deposits. The actual return or loss are based on the exchange rate at the point of maturity relative to the initial rate. If you had bought US dollars at the most recent peak in September 2022, one greenback would have cost you around $1.40 Singapore dollars. So your deposit of 10,000 US dollars would have cost 14,000 Singapore dollars. At 3% per annum interest for a 12-month term, you would receive 10,300 US dollars at the end of the term. If the US dollar goes up, you'll get back your interest plus the currency appreciation. But what actually happened was that the US dollar went down. In September 2024, the US dollar hit a 10-year low against the Sing dollar. That currency depreciation will eat into your interest. And if the US dollar continues to go down, you could even end up with less than what you originally put in.
Similar to a Sing dollar fixed deposit, the foreign currency fixed deposit, or FCFD for short, essentially allows a customer to put away their money, lock up in a fixed deposit account for a set period of time for a higher interest rate. Some of the advantages including a very attractive interest rate, time to time. The banks actually run promotional interest rate on these various accounts, and customer can actually enjoy the attractive return. The next thing that customer can also get to enjoy is actually a certainty of returns. Customer typically will know the interest rate that they are committed to at the time of placement, and with that in mind, they have assurance that the interest that they will be getting back at which point in time. Third, customer can also allow the fixed deposits to be rolled over, and with that in mind, they are also able to enjoy interest rate at the prevailing terms.
However, these products also come with risks. Sing dollar deposits are covered by the Singapore Deposit Insurance Scheme. This protects deposits for up to $100,000 per depositor per bank in the event of a bank default. Foreign currency deposits are not covered by the scheme. But despite such risks, this asset class can help with portfolio diversification.
As the global economy continues to progress, as the market continues to expand, there are increasingly a lot more opportunities in different asset classes. So foreign currency is just one of the many asset classes that one should consider putting into its portfolio. Foreign currency also plays a very important part in other asset classes. Point in case, if you are buying into a US equity, you will need to buy US dollar first before buying into a particular stock in the United States. So for a consumer, you really want to consider the needs and objective of this deposit. Typically, we see investors who buy into a particular currency invest for a particular purpose. The usual case is a child's education, investment property overseas, or maybe an overseas transaction, or maybe a long-term holiday. The time horizon is a reflection of individual needs. For education purpose, I think that's a very long period of time. Parents typically use a staged approach in terms of buying into a foreign currency and investing that into the fixed deposit. Because bear in mind, once a deposit matures, it's highly dependent on what is the interest rates in that future. It could be higher, it could be lower at the same time. So you will experience a rollover risk, and that is something that investors need to pay attention to as well.